China is certainly vulnerable to a downturn in Europe because Europe is its single largest market if you take Europe as a whole. And even though China has become a little bit less dependent on exports to generate growth over the last few years, exports are still a very, very important part of the economy. So if exports to Europe and other places slow down, this could reduce GDP growth quite significantly, at least percentage points, probably as much as 2 percentage points if Europe goes into a recession. And if the recession were to be prolonged, which some people are worrying about, then it could have a quite negative effect on China's economic growth for a couple of years. China's growth is already softening, in part because the housing market is beginning to slow down a little bit. The Chinese leaders are more constrained today than they were in the second half of 2008 when the global crisis really began to loom very large. Because at that time, back in 2008, the household sector had very little debt, the government sector had very little debt, and the corporate sector had very little debt. So while the rest of the world in the wake of the financial crisis has been deleveraging, trying to pay down their debt, in the financial crisis, China had a big stimulus program funded primarily through bank lending. And since the initial levels of indebtedness were low, it was quite possible, quite feasible for the household sector, for example, to borrow a lot more money. So one of the big sources of growth in China in 2009 and 2010 was a big boom in expenditures by households. A lot of it was for housing. But household debt as a share of their after-tax income in those 2 years almost doubled. Really unprecedented increase in the indebtedness of the household sector. And government debt, which was relatively low to start with, also almost doubled in a 2-year period. So they have less flexibility today. They cannot launch a big lending program because the borrowing capacity of both the state and the household sector is very heavily constrained compared to what it was 2 years ago. They have a little bit of leeway on the fiscal side. They've had very strong growth of fiscal revenues, tax revenues. So the government could engage in somewhat limited fiscal stimulus, increasing government expenditures. But I think the reality is that the Chinese would have to accept much lower rates of growth than they have become used to in recent years if Europe really does go into a prolonged recession, and particularly if the US goes into recession as well. If Europe really does weaken the way some people are anticipating, that China should be thinking about how to live with a 7% rate of growth or maybe even 6.5% growth for a year or maybe a year and a half until Europe begins to recover. The underlying problem, I believe, in the housing sector is that since real rates on bank deposits have been negative now for more than 7 years and house price appreciation has been very high, households have allocated a larger and larger share of their wealth into real estate and they put less money into bank deposits. Now, the Chinese situation is very different from the United States because the Chinese have adopted prudential measures. If you're buying a house, then you need a mortgage, but you're not going to live in the house. You know, the down payment rate required to get a mortgage is extremely high. So there would have to be a massive price correction before people would be in negative equity. The big risk for China is more what I call a macroeconomic risk, because if housing investment slows down, that means less demand for steel, less demand for cement, less demand for copper and aluminum, and so it has ripple effects throughout the economy. So a property investment slowdown would have a very substantial adverse effect on the growth of the economy, but it might not precipitate a financial crisis of the magnitude that we saw in several advanced industrial economies.